Get the fastest internet available in North Central Washington by switching to LocalTel and get speeds up to 1,000 meg. Call 888-8888 today or go online to localtel.net.
Welcome to Let's Learn here on the NCW Life Channel. I'm Eric Granstrom, your host, and it's that time of year where we start talking about taxes. And to get a few tips along the way, we've enlisted the services of the folks at Cordell Naring Company. We've got Tim Dilley joining us again this year. Tim, anytime I see you guys, it's Happy New Year.
I guess it is.
I don't know. Taxes and happiness, I just don't know if that's necessarily something that's symbiotic or not.
I probably view the coming of the new year a little differently than most.
Yeah, especially the rush towards the end of a year as you try to get everything done beforehand. But that's something we're going to talk about today, is that with the new tax laws that came into effect at the end of 2017, as we're wading into it here for 2018, there's actually some things that people can do retroactively, which is kind of an unusual thing, I think.
From time to time, we weren't exactly sure, and really, as the 2018 tax bill was coming into shape, I was a little bit caught surprised by a few things that did go retroactive into 2017. We've certainly had lots of other legislation in the past that was retroactive to the beginning of that tax year that it was passed at the end of. But that was generally fixing things. In this case, it was a fundamental change to the tax law, and they did creep back into 17 for some period of that. So. Okay,
so kind of give us an overview of what we're going to talk about today and what the structure is of our conversation.
So I thought I would focus on the 2018 tax law, which was the Tax Cuts and Jobs Act, or H.R. 1. Because actually, when they posted the final text of the bill on the books, they dropped the title that we've been using all along. So I'll stick with H.R. 1.
Okay.
Or you might catch me still referring to it as the Tax Cuts and Jobs Act. But there's a few things I'm going to talk about, and they're basically business focused today. So. Okay. The first thing, which was sort of the headline of the whole tax bill and the momentum of the whole tax bill, was corporate income tax rates. Everybody heard about this part. Corporate income tax rates were lowered from the top rate of down to 21%. So why did they pick that? It was all just negotiations, but really the design was to make United States corporations' taxation more competitive with the global landscape. As a matter of fact, 21% is still on the high side of a similar type of taxation around the world of those domestic corporations. So what did we get? We got a flat tax for corporations at 21%. Flat tax, right? We haven't had that actually on the books. People talk about flat tax and, like, wow, wouldn't that be great? Well, we got it in corporations, flat tax. So is that a good thing? Well, for some it is. If you're a modest corporation, though, remember that now you have now lost the 15% bracket is gone. The 10% bracket is gone. So if you were a corporation that didn't create a whole lot of taxable income every year, but you just happen to be in that particular type of tax structure, you actually lost a little bit of benefit. But most of the corporations we talk about are certainly maybe up into the 25%, 35, 34, and then 34 beyond. In which case, they got a great benefit, very significant change in taxation when you're talking about that kind of differential. And these don't just benefit the Wall Street corporations that everybody was sort of talking about in this. I mean, yes, it benefits the Apples and whatnot of the world, but I mean, we've got a lot of local C corporations here in Wenatchee, businesses that we may all know, some that we don't, but this is a benefit to them as well. And like I said, it's a significant benefit, and these tax dollars not going to Uncle Sam means that they're available for other things, and so it's pretty exciting to see what these companies are going to be able to do with primarily reinvestment, because I'll tell you, the local corporation is typically not focused on dividending out these additional earnings. They're generally looking to, how can I spend this within the business? So that those local corporations, this is a great thing for our local economy in that regard. So
the big headline, I think, after that was Boeing reinvesting $600 million into their employees was the headline. We're seeing something, well, obviously not to that scale, but something that could possibly be a similar investment in employees here in North Central Washington?
Certainly, I've only seen a couple of bonuses or whatnot from C corporation type entities to their employees, basically for this, for because of this reason, along with a good year as well. But there is some of that trickle down that's happening here. Certainly not to the Boeing scale, but that, like I said, those are real cash dollars that are there available now for a different use rather than to Uncle Sam.
So, and by the sounds of it, and I've talked with a few of your colleagues in your office now so far on the tax tip series here on the NCW Live channel, and it seems like a lot of the tax changes at the end of the year are benefiting the wealthy. They're benefiting larger companies. The small businessman or woman, not so much. Is that accurate?
I think there's benefits across the entire strata of tax brackets and sophistication. The mom and pop simple tax return, if for no other, if we sort of take out all these complexities, all rates lowered in those lower brackets. So I mean, that's a good thing. Whether they just get a little 2%, 3% benefit, I mean, that's still a benefit. There's certainly lots of circumstances where you could say it didn't do much, or it didn't, that guy got more than I got. But life's not fair. Right. And everybody's tax situation is different, which is why when somebody says that, it's like, it just depends. It depends. I will say it was very beneficial to business because I started by explaining the corporation part of it, but then unfortunately, tax law is kind of like hurting a bunch of 4-year-olds. He got something, so guess what? Everybody else is like, what do I get? Yeah. Gimme. And so that's where we're going next. Is so we talked about C Corps. What about other types of businesses? Okay,
we'll talk about that after the commercial break. We're talking tax tips here with Cordell Nair & Company and Tim Dilley. We'll come back with more on the tax reforms and what it means for business next on the NCW Live channel.
Is your vehicle in need of a quick oil change or tune-up before hitting the road this summer? Stop by Quick Lube and Tune, the home of the good guys at 610 South Wenatchee Avenue.
Welcome back to Let's Learn on the NCW Live channel. I'm Eric Granstrom, joined by Tim Dilley, Certified Public Accountant with Cordell Nair & Company, talking about tax reforms for 2018 and what it might mean to your business. So, Tim, we kind of teased it. So what are we looking at? Let's dive into this a little bit here for business man or woman here in North Central Washington.
All right. Like I said, the headlines, the national news was all about those corporate tax rates, and there was that benefit provided there, but like I said, once you drop somebody's tax rate over here, you get a whole bunch of other people screaming, hey, what about me? So here's the thing that's not the headline, and I suspect it's not the headline because it's so stinking hard to explain. Okay. But in our world, this is the thing that we've been trying to digest and are craving some more clarity on. But what I'm talking about is the pass-through deduction. So we refer to it as the 20% pass-through deduction. What happened here? Well, the IRS said, or Congress said, Congress said, if we're going to give these C corporations this tax benefit, we shouldn't ignore these other forms of business. Other forms of business include Schedule C sole proprietors, partnerships, and S corporations, right? That C corporation could have been any one of those others, depending upon the size and a lot of other things. But just because of that particular choice of formation, why should these other businesses not get some sort of benefit? So they came up with the pass-through deduction. And why do they call it the pass-through deduction? Because an S Corp and a partnership are pass-through entities. Those are entities that file their own tax return, but they don't pay tax at the entity level because they pass out all income or losses every year via a Schedule K1 that goes out to the shareholders or partners of those entities. Now, a sole proprietorship is what we often refer to as a Schedule C, or it could be a farm on a Schedule F. Those are attached directly to the personal returns of the individual taxpayers, and so there is no pass-through there because it's already there. But anyway, they all get to participate in this. And what is this? This is the biggest change to the tax code in my career and the most complicated part of the 2018 tax legislation that we got. It's basically a complicated series of math exercises where the formula is where you can take a deduction equal to the sum of the lesser of combined qualified business income that I'll refer to as QBI from here on out. And we have to actually stop right there and drill down to what is QBI. QBI is the lesser of 20% of the taxpayer's qualified business income, so the income from that entity or activity, or the lesser of 20% of that QBI, or the greater of, so I'm just drilling down.
Okay.
I'm drilling down.
Yeah.
Or the greater of 50% of W-2 wages, or 25% of W-2 wages and 2.5% of qualified property.
Okay.
Get your head around that.
Yeah.
Well, I've spent a lot of time doing the research, trying to understand this. I didn't even give you the whole formula. There's a couple other kickers in there for if you're invested in real estate, trusts, or publicly traded partnership. But I'm going to ignore those in this because they're generally fairly minor to most taxpayers. But we do a lot of math to get to that point, and so there's a lot of strategy that's employed there. But that's the formula. And so that last piece that I described, that's how we get to that QBI. But then I circle back to where I'd started, which was the lesser of the QBI, or 20% of the excess taxable income over the sum of net capital gains. Okay? So the frustrating part for us is that we can do a ton of work to calculate a number that we then take back to essentially the main form of the individual's tax return, the 1040. And then we've got to run a couple of other governors to that to see, okay, am I limited now at this level? So that's what it is. It's just a series of limitations. If you don't pay enough wages, then you can't take the whole benefit, which is, designed to be a jobs growth incentive there. Sure. If you're getting a whole bunch of capital gain in your income, in your taxable income, then they're gonna back off some of this pass-through deduction that you can take because capital gain income is already preferenced with special rates that are lower than ordinary rates. And so that's what's kind of frustrating, is that you're going to do all this math, but you have to be aware of if the facts and circumstances of the individual's tax return can still limit that deduction. Because a lot of these calculations will have to happen at the entity level to figure out what is the QBI of that entity. And again, this is a pass-through entity, and the deduction is taken at the individual level. So what I foresee, I don't know, but I foresee there's going to be a schedule attached to our schedule. The K1 is going to have to tell us some information,
right?
And not just a few lines, but several pieces of information. Because again, we have to know what is that individual pro rata share of the W-2 wages of that entity. You're going to have to know that in order to do this calculation at the individual level. So there's a whole bunch of information that's going to pass through from these K1s, from these entities tax information that we then run the numbers at the individual level as well to see if we have other pieces that will limit the deduction.
So to try to simplify this a little bit, on the individual level, there are certain credits you could qualify for, but you have to check that against your income level in order to qualify for that. And if you don't, then you can't qualify for that, so you got to go to a different type of credit to search for that.
This is not a credit, this is a deduction. Right. And there's some other caveats of different income levels come to different conclusions. A lot of the conversations have been, well, does this mean I want to be an S Corp? Well, no, or it depends. It depends upon the income level. There are some other governors in this, in that if you're in a service industry, you're limited. If your married filing jointly taxable income is above $315,000, then you probably cannot take this deduction, and period, you're done. It fully phases out over the next $100,000 of taxable income. So basically it was to make sure the fat cat lawyer in Washington D.C. that's pulling in $600,000 doesn't get any of this benefit, and he doesn't. But if your income is below that, even some of those specified services like doctors, lawyers, accountants, they do actually have the opportunity to participate in this, and to the same degree that other non-service kinds of businesses do as well. So it's a pretty big deal for most businesses, and there is no simple answer. There is no blanket answer. It's like going back to that entity selection, there's not a slam dunk answer to that. Right. The entity is going to depend upon your income level because of all these different pieces. So you might think the very unsexy Schedule C for the attorney it makes no sense whatsoever. Actually, that's the sweet spot of where this attorney wants to be if they're only making a couple $100,000 a year in qualified business income. You flip them to another entity structure, and they're going to probably lose out on so much of the deduction because of some of the clawbacks in the formulas here.
Okay, all right. I'm gonna have you pause right there. I think everybody needs a little brain refresher here, so take a deep breath.
Please join us weekly for the 12th District with yours truly, Kerry Condata. Check your channel guide for times or go to ncwlife.com for details.
Welcome back to Let's Learn here on the NCW Life channel, talking tax tips with Cordell Nair & Company, and Tim Dilley joining us. So Tim, the good news through all of this, and as difficult as what you just described to us can be, not only for business people, for you, who's an accountant who you make your living figuring these things out, the good news is, though, that we can go retro for 2017 still up until the tax deadline, correct?
Well, we've got one great area of the tax law, this new tax law, that actually crept back into 2017. And what was that? That was what we call bonus depreciation, which is Section 168K depreciation. We refer to it as bonus depreciation. Bonus depreciation, which is on the books right now for 17, and was prior to this legislation, says that if you had an initial use asset, initial use is the way that the IRS says new, so not just new to you, but actually initial use of that asset, you could write off 50% of that asset's cost as essentially accelerated depreciation in that first year. And then on the other half of the asset's value, you took regular depreciation on it. So different than what we call Section 179, where you just elect to expense some or all of that. It just works a little bit differently. But so the new tax law says if you purchased an asset after September 27th, 2017, you can use this new 100% bonus depreciation that's in the tax law.
Wow.
So I did not expect that to be retroactive into 17. Saw it coming in the tax law for 18, but why did they creep back to September 27th, 2017? Yeah. Oh, we've come up with all sorts of fun conspiracy theories as to why that is. So-and-so bought a building the day, or bought a business the day after that date. And so, I don't know. I think the most logical conclusion is there was a committee that passed it, through some milestone on that particular date, and that's where they hung the hat there. But it's pretty exciting. So that's now. That's the tax returns we're doing now, where we've got a part of the year under one set of rules and a part of the year under another set of rules in regards to depreciation for those business assets. So
are there tipping points for that on levels of?
There isn't for bonus depreciation, which is, you know, as opposed to Section 179 that has a maximum, and for 2017 that maximum is $510,000. In 2018 they raised it again to $1 million. So there's still that opportunity, but the character of these two types of depreciation tools are different. In that bonus depreciation, which, oh, by the way, now counts for, I said initial use assets, it now counts for used assets as well. So they added that as well. So you could, if you bought a used business asset after September 27, 2017, you have that 100% bonus. That you're essentially expensing it, but you're not really expensing it. You still capitalize it. You just happen to be depreciating it fully in that first year. Pretty exciting stuff for those of us that like to use the tools to manage taxable income as much as possible. So, so that was a huge change. The fact that we have 100% used assets and retroactive back to part of 2017. So we had to jump on that pretty quick and make sure that we understood that. There's also some definitions that were changed as far as improvements to property. And what I mean are more real property type of improvements, buildings, okay? Buildings are, you know, sort of stuck in those long-lived assets of 39 years, which is codified. That means IRS said, thou shalt use 39 years. We didn't make that up. And I see these things, these pieces of those buildings kind of tip over year after year of where now you don't have to capitalize a particular type of building system and depreciate it over 39 years. You actually can call it a qualified property improvement, take a 15-year life, although that's not in the tax code right now because they forgot to define it as 15. Oops. Yes, there is corrective legislation coming. Of that, I guarantee, because there are several areas of the tax law in this new bill where they made oopsies, and they know it, and this is common. Anyway, so some of those building improvements that used to be forced to be capitalized and depreciated over 39 years now qualify as qualified improvement property. They get a 15-year life once they fix it, and then they qualify for bonus. So some of these building systems have totally flipped, you know, to where it used to be your fire suppression system had to be a 39-year asset, just like the building. Well, you and I both know that fire suppression system is primarily technology these days, and then maybe, you know, piping and whatnot, but very technology dependent. It makes a lot more sense for that to not be a 39-year property. So it's kind of interesting to see that also happening.
They've come to the age a little bit there.
Perhaps.
I want to ask you real quickly here, new tax law, it's enacted by Congress. Is it political, or is it, I would hope there's a bunch of accountants that are working on it, and folks that know all tax code and everything. Or is that a loaded question?
I suspect it's a little of both. Okay. Clearly, sometimes you're sort of left scratching your head saying, why? You know, Rubio basically held out on his bill until another few $100s went to the child tax credit. I mean, to me, that's political. There was no economic study of that. That was just, until it gets to here, I'm not going to cast my vote. Okay, we'll move it there. That was, I mean, 100% political, right? He had his reasons for doing that, but you know, that's not a bunch of accountants in the room saying this makes more sense. That was somebody buying a vote.
As always with these conversations, we just scratch the surface, and time says we got to wrap up the program. So if we've triggered some conversations, which I know you probably have, especially with this last conversation about taking some of the benefits retro to 2017, how do they get a hold of you in your office and be able to continue that discussion?
Sure, we're a local firm in Wenatchee, out in Old Station. Our number is 663-1661, and we have 20-some professionals that are happy to answer phone calls if people have questions.
It's a busy time of year for them. Contact Cordell Nairn Company. This is Tax Tips, and Let's Learn on the NCW Life channel.
Are you wanting high-speed internet but don't have access to PUD fiber? Try Sky-Fi high-speed wireless internet from LocalTel. Call 888-8888 today.